This is a 5-part webinar series. As you can see, I've arranged the topics in a progression that I think will help, that builds on itself and that will give everybody a solid foundation for understanding what is to come. Here in Module 1, we're going to discuss the elements of the Form 8938. What I mean by that is we are going to deconstruct the rule into its most important parts and then do a deep dive into each part to make sure that we understand how the terms are interpreted or defined by the IRS. And we're going to do that in 2 parts. And we're going to cover the first part of the rule, the elements for the first part of the rule in Module 1, and we'll cover the elements for the second part of the rule in Module 2. In Module 3, we'll discuss reporting thresholds. In Module 4, we'll discuss penalties and statute of limitations. And in Module 5, we will do a comparison of Form 8938 and the FBAR requirements. Now, Form 8938 is probably one of the more confusing international reporting forms that we have. And once a person gets a general understanding of Form 8938, it's very easy to confuse the requirements and the definitions of the elements of that rule with the FBAR requirements. So Module 5 is like a quick and dirty way of contrasting the requirements so as not to confuse them. Now, because Form 8938 is so vast and is so overlapping, I thought we would best start out with a moment of levity. And what better place to start than with The Simpsons?
Feel like working, God bless them. Daddy, what do taxes pay for? Oh, why, everything. Policemen, trees, sunshine. And let's not forget the folks who just don't feel like working, God bless them. Daddy.
Okay, now we're ready to launch in to some background information about Form 8938. The U.S. government is miffed about widespread international tax noncompliance, and it's not holding back how it feels about those who continue to play tax hanky-panky. It's like that expression after somebody has just gone off on a diatribe. Tell me how you really feel about it. We clearly get Uncle Sam's hint on how it feels about widespread international tax noncompliance. A day doesn't go by that there's not a new press release coming out from the Department of Justice about a new person who has become the target of a criminal indictment relating to their willful failure to file an FBAR or international tax evasion or anything along those lines. Now, the government took a major step to address the problem. One of those steps was none other than the enactment of FATCA, the Foreign Account Tax Compliance Act. FATCA is sometimes referred to as FATCAT, and it was loaded to the hilt with various tax provisions, including 6038D. Well, what is so important about 6038D? 6038D requires certain U.S. taxpayers to report information to the IRS about their foreign financial assets on a Form 8938. So if you're looking for the culprit or the reason why we have this Form 8938, it harkens back to FATCA. FATCA breathed life into Form 8938 through this code section 6038D. Why is it important to comply with Form 8938? Well, not unlike the F-bar, there are consequences. Violations trigger a parade of horribles. First, there's information reporting penalties. Second, increased sanctions for understatements. Third, an extended period for IRS enforcement. And fourth, potential criminal charges. The last one always gets the attention of people. So what do I mean by this labyrinth of overlapping rules? Well, the general rule looks innocent enough. And let me just stop there for a second. When I say that the general rule looks innocent enough, you can read it even if you do it for the very first time and say to yourself, oh, seems easy enough. What is Mike talking about here? He's making much ado about nothing. The problem is this, and this has become a trademark in tax compliance. The IRS tends to use terms in defining requirements for completing forms that have everyday meanings to them. And so when we see a term like financial asset, foreign, it's very easy for us to impute the meaning that is most associated with that word in our daily lives, and how can we be faulted for doing otherwise? Well, that is a veritable trap. And the reason why it's a trap is because these are terms of art that have very precise definitions that were spawned in temporary regulations and final regulations, and definitions that or interpretations of that were given by the courts after litigation. So that's what the major trap for the unwary is, imputing an everyday definition to a term, and assuming that everyday definition applies to that term when it actually is defined perhaps radically different. So that's why it's so important to drill down and to isolate the parts of the rule into its individual parts, and then discuss the definition of each element. So this rule is, or this requirement is loaded with abstract and vague concepts that have led many to call it a riddle wrapped in a mystery inside an enigma. Even though Section 6038D was enacted back in 2010, the IRS hasn't provided taxpayers with clear guidance on its complex rules. Where does that leave us? Well, it leaves us with a jumble of convoluted temporary regulations issued back in 2011, final regulations promulgated back in December 2014, Merry Christmas, and countless iterations of the instructions for Form 8938. Without further ado, let's jump into the rule. Any individual who, during any taxable year, holds any interest in a specified foreign financial asset shall attach to such person's tax return for such taxable year the information described in subsection C with respect to each such asset if the aggregate value of all such assets exceeds $50,000. Wow, what a mouthful. But at the same time, as I'm reading it, I'm sure that you're in your mind able to conceptualize what the spirit of this rule is and what's going on here. Unfortunately, however, the devil is in the details. So let's break the rule down into manageable pieces so that we're not forced to drink water out of a fire hydrant. First, any specified individual. Second, who holds an interest. Third, during any portion of a tax year. Fourth, in a specified foreign financial asset. Fifth, must attach to his timely Form 1040. Sixth, a complete and accurate Form 8938. 7. If the aggregate value of all specified foreign financial assets. 8. Exceeds the applicable filing threshold. Who must file a Form 8938? According to the final regs, the following categories of individuals are considered specified individuals. So, specified individuals answers the question you see at the top here. Who has to file? And contrary to what most people might think, it's not limited to only U.S. citizens. Naturally, U.S. citizens is at the top of the list. But second, we have individuals who are not U.S. citizens, but who are U.S. residents for any portion of the relevant year. Third, non-resident aliens who affirmatively elect under Section 6013G or Section 6013H to be treated as U.S. residents for federal tax purposes. Fourth, non-resident aliens who are bona fide residents of Puerto Rico. And fifth, non-resident aliens who are bona fide residents of a so-called Section 931 possession. And here you see in parentheses, American Samoa. No tax requirement, no Form 8938 requirement. That might be the simplest way out of the 8938. Essentially, specified individuals who have no duty to file Form 1040 or Form 1040NR need not file a separate Form 8938. So in the rare case that a Form 1040 or a Form 1040NR isn't required, the taxpayer need not file an accompanying Form 8938. Even better, the instructions for Form 8938 enlarge this idea. How so? Well, if a specified individual has no tax return filing duty, then he has no Form 8938 filing duty, even if the value of the specified foreign financial assets exceeds that person's reporting threshold. What period of time does a Form 8938 cover? This is simple enough. It begins each tax period on January 1st and ends on December 31st. When does an individual hold an interest in a specified foreign financial asset? Well, some background information is in order first. Holding an interest varies significantly when it comes to Form 8938. So I don't want you to think that there is one way of holding an interest and one way only. Instead, there are a multitude of ways that a person could be considered to hold an interest for purposes of this Form 8938. This has caused enormous confusion among taxpayers and practitioners alike, since holding an interest for purposes of Form 8938 is not the same as holding an interest in an asset when it comes to the FBAR reporting requirements. So this is a trap for the unwary. Those who have familiarity with the FBAR reporting requirements may be trigger happy and think that because they understand the meaning of holding an interest for purposes of FBAR reporting requirements, that they automatically understand the definition for holding an interest for Form 8938. Unfortunately, that is where many taxpayers get into trouble. Even though both the FBAR and Form 8938 are foreign asset reporting forms, the use of the same terms by both forms doesn't mean that they are interpreted identically. In this case, there is a radical difference between the definition of holding an interest for purposes of the FBAR and holding an interest for purposes of Form 8938. Now, what does it mean for a specified individual to hold an interest in a specified foreign financial asset for 8938 purposes? Well, generally speaking, a specified individual has an interest in an SFFA if any income, gains, losses, deductions, or credits attributable to holding or disposing the SFFA are reported, included, or reflected on the specified individual's annual tax return. So, the most basic way to understand whether a specified individual has an interest in an SFFA is to view it like this. It's viewed very broadly. And it's viewed very broadly because all that's necessary in order for a specified individual to have an interest in an SFFA is if income, gains, losses, deductions, credits, any one of those that's attributable to the holding of the SFFA have been reported, included, or reflected on the person's annual tax return. So, quick and dirty way of dealing with this is that if you have an SFFA that has resulted in income, gains, losses, deductions, or credits that you had to report on your annual tax return, then, and you're a specified individual, then you have an interest in an SFFA, and you have potentially have, I should say, a Form 8938 reporting requirement. The reason I say potentially is because there are other elements that have to be satisfied as well. But this is one of the earlier threshold requirements that comes up right out of the gate. And note very well that a specified individual must file Form 8938 even if none of the specified foreign financial assets that must be reported affect his U.S. tax liability. Interesting here. On the one hand, we're talking about if the holding or disposing of the SFFA results in income, gains, losses, or deductions that have to be reported on a 1040, we know that the person then has an interest in the SFFA. But it doesn't have to affect the person's U.S. tax liability. So even if the SFFA produces income, gains, or losses, but that income, gain, or loss doesn't affect the taxpayer's U.S. tax liability, it still doesn't alleviate the taxpayer from the requirement of having to file a Form 8938. Once again, income, gains, losses, deductions, or credits arising out of the holding or disposing of the SFFA do not have to affect the taxpayer's bottom line, namely his U.S. tax liability, in order for the person to have an interest in an SFFA. As long as there was income, gain, loss, deductions attributable to the holding of the SFFA that were reported on the person's 1040, then that's sufficient for a person to have an interest in an SFFA. So let's talk about the special rules about holding an interest. No entity attribution. Now, I'm going to cover the rule here, and this is critical because you're going to see how it diverges from the FBAR reporting requirement. And this is a major, major trap that a lot of taxpayers fall into. So here's the rule for entity attribution. An interest in a specified foreign financial asset is not automatically attributed to a specified individual merely because he owns an interest in an entity that actually holds a specified foreign financial asset. I'll say that again. An interest in a specified foreign financial asset is not, I repeat, is not automatically attributed to a specified individual merely because he owns an interest in an entity that in turn holds a specified foreign financial asset. So what the hell does that mean? Well, let's set this up. Let's say that we have Fred, and Fred is the majority shareholder of a foreign corporation. Let's say that he owns a 51% stake in the foreign corporation ABC. Let's say that that ABC in turn holds an interest in a specified foreign financial asset. So under those circumstances, Fred indirectly owns an interest in the specified foreign financial asset. He owns it indirectly because he is a majority shareholder of the foreign corporation ABC, and ABC in turn owns an interest in the specified foreign financial asset. Here's the question, the critical question for 8938 purposes. Is Fred treated as having an interest in the SFFA as a result of his status as a shareholder of the foreign corporation? No. No, he's not. So even though, or as tempting as it might be to attribute to Fred an interest, a direct interest, or an indirect interest rather, in the specified foreign financial asset as a result of his majority stake in the foreign corporation ABC, as tempting as that might be, for 8938 purposes, Fred is not treated as having an interest in the specified foreign financial asset. Now, this is where This is why this is a veritable trap for the unwary. In contrasting this with the FBAR reporting requirements, the FBAR requirements generally require the reporting of foreign financial accounts, regardless of whether the taxpayer holds them directly or indirectly. So in the example that I've just given you, where Fred is the majority shareholder of ABC, and ABC in turn owns a foreign bank account, we know for FBAR reporting requirements that Fred is considered to own the foreign bank accounts indirectly through the entity ABC. So the only twist that I've given you here between the first hypothetical where ABC owned a specified foreign financial asset and the second hypothetical where ABC owned a foreign account is that the difference, of course, is in the first case the foreign entity owned a specified foreign financial asset, and in the second case the foreign entity owned a bank account. But what I'm trying to highlight here is the confusion that this causes, because if Fred is a majority shareholder of ABC, and ABC in turn owns foreign bank accounts, assuming that the foreign bank accounts that ABC owns exceeds the reporting threshold for FBAR that triggers the FBAR, then Fred has to disclose his indirect ownership of the foreign bank accounts on an FBAR. And that's what sometimes confuses taxpayers, because they assume that the same logic applies in the world of 8938 and will automatically and falsely assume that because Fred indirectly owned the specified foreign financial asset through ABC, that Fred has an interest in that specified foreign financial asset. But as we've now come to find out, he doesn't. Second, disregarded entities holding specified foreign financial assets. A specified individual who owns a disregarded entity is treated as having an interest in any specified foreign financial asset that is held by such entity. And we get that from the instructions. If you are the owner of a disregarded entity, you have an interest in any specified foreign financial assets owned by the disregarded entity. Grantor trusts holding specified foreign financial assets. That's our third. Generally speaking, a specified individual who is the owner, whether full or partial, of a grantor trust is considered to hold an interest in any specified foreign financial asset that is actually held by such trust. So, if the grantor trust holds a specified foreign financial asset and a specified individual is the owner of that grantor trust, then the specified individual is considered to hold an interest in the specified foreign financial asset. Fourth, specified foreign financial assets held by children. A specified individual who makes the kiddie tax election under Code Section 1G7, meaning elects to include certain passive income of his child as his own gross income for U.S. income tax purposes, is considered to hold an interest in any specified foreign financial asset held by the child. So that is a mouthful. Let's go through it once again. We have a specified individual. That individual makes the kiddie tax election under Code Section 1G7. Now, what do we mean by making the kiddie tax election? he or she elects to include certain passive income of his child as his own gross income for U.S. tax purposes. That person, that specified individual, is considered to hold an interest in any specified foreign financial asset held by his child. Where do we get this from? This comes from the instructions for Form 8938. Fifth, certain non-vested specified foreign financial assets. Here's the issue, and what I tried to do is frame it as clearly and as concisely as I could here. Does a specified individual hold an interest in property that has been transferred to him in exchange for the performance of personal services if the specified individual's interest in that property has not yet vested? Ooh, sounds like a complicated scenario. But let's break it down here. We have a specified individual, and he has received property from somebody in exchange for having performed personal services for that person. Now, by property, we're not necessarily confined to to real estate or anything that narrow. I mean, property could be cash, it could be notes. It's given a very broad definition under the Internal Revenue Manual. But what we have here is a situation where someone has performed personal services and has received property in exchange for compensation. But the person's interest in that property has not yet vested. Must the person, does the person rather, hold an interest in that property if it has not yet vested? We have two rules for non-vested specified foreign financial assets. Rule number one, a specified individual who receives property for the performance of personal services is considered to hold an interest in the property for purposes of Code Section 6038D on the first date that the property is substantially vested. Once again, under the first rule, a specified individual who receives property for the performance of personal services is considered to hold an interest in that property for purposes of 8938, beginning on the first date that the property is substantially vested. Rule number two, with respect to property that a specified individual elects to be taxed immediately at present value on the entire amount that will eventually vest, the specified individual is deemed to hold an interest on the date the property is transferred. So, with the second rule, we're dealing with a situation where the individual elects to be taxed immediately at present value on the entire amount that will vest at some later time, some future time. In that case, the specified individual is deemed to hold an interest on the date of the transfer of the property. We've now come to the end of our first module. If you have any questions that have come up in the first part, please don't hesitate to contact me. My door is open and I'm more than happy to take any questions from you. Please keep in mind that the information discussed in this first part as well as in the subsequent parts is very general and it has not been customized to your individual situation. So it's impossible to rely on information that is general and broad. I encourage people all the time to consult with a tax attorney and not to leave any of this to chance, and certainly not to guesswork. So I look forward to seeing you in module number 2.